Hello everyone, good afternoon. Uh, Whether my voice is audible to everyone and can you see my presentation?
Yes, sir.
Okay, so we'll wait for 2 minutes and then we'll start our lecture. Some students are joining in between. Okay, uh, in the last lecture we have started evaluation criteria for investment decisions. Okay, so these evaluation criteria are very important and they will suggest whether one have to start the investment in a particular sector or not. Okay, or it will useful to establish the new business also. So this particular evaluation criteria will be the guideline for the new businesses also. Okay, so this evaluation criteria will helpful to find out the benefits over the time period. Okay, over the time period. So what is important for the evaluation criteria? That is for first part, that is nothing but cash inflow and cash outflow. Okay, so these are the basic important points to calculate the evaluation criteria. Okay, so you also noted this particular seven evaluation criteria. Okay, and in the last lecture we have started the first one, payback period. So payback period is nothing but the time period uh, required to recover the investment. Okay, time period required to recover the investment. Okay, so this particular payback period will be calculated n is equal to I divided by b. Okay, n is equal to I divided by b. So n is nothing but payback period in years, I is nothing but initial investment, and b is the net return per annum. Okay, so net return is nothing but what, after subtracting the working capital, whatever the returns we are getting, so that is nothing but the net return. Okay, and here the suggestion for the businesses or any investment is that if the payback period is shorter one, then that particular business or that particular project is more desirable. Okay, when the payback period is shorter one, then that particular business or that particular project is more desirable. Then we have seen the strength and weaknesses of payback period. So the simple formula to calculate. So calculations are very simple and it is very easy to understand. Okay, and also there are some weaknesses for this particular payback period. So the formula will give the answer in a years. Okay, or the time period. So it will not speak about the money. Okay, so answer in years, not in dollars. Then it will speak about the payback period only. Okay, how much time required to recover that particular money. So it will not give any information about after that particular period. Okay, after that particular period, because business will not run up to the payback period. Okay, so if you want to earn the profit, then you have to run the business beyond the payback period. So this particular payback period criteria only gives the information related to that particular period in which the company or that particular firm recover the investment amount. Okay, and it will not account for the time value of money. Okay, now you have understood what is meant by time value of money. So once again I will suggest you that if you want to uh, take the loan from the bank, okay, so it will provide the loan to you, but once you want to pay that particular loan, then some interest you have to pay over that. Okay, so the value of money will not be same. Then again we can take that inflation, or in Marathi it is called as a mahgai. Okay, so this inflation rate is also changing day by day, and it will affect on the value of money. So if you remember some of the products you will get through shop at rupees 1, rupees 2, rupees, and in your childhood, but nowadays that products are near about 5 rupees, 6 rupees. Okay, so that is nothing but what the value of money goes on changing. Okay, so this particular payback period does not take this particular change in value of money, or we can say that time value of money. Okay, so if you want to invest for a FD, okay, so uh, uh, if you invested 1 lakh rupees, then after 6 years you will get the 2 lakh rupees. Okay, so that is nothing but what value of money changes day by day. Okay, and it will change according to the periods also. So but in this case, in payback period, this value of money is not taken into account. Okay, so these are the weaknesses for the payback period. Then next we have seen the example over over this particular payback period. So the initial investment is provided, and the return on investment for per year it is provided. Okay, so the initial investment I is equal to 10 lakh dollar, and the return from that particular investment is 2 lakh $50,000 per year. Okay, then how much, or what will be the payback period? So the investment divided by the net return per year. Okay, so 10 lakh dollar divided by 2 lakh $50,000, so we will get the number of years, that is nothing but 4 years. Okay, so it is useful to find out the payback period to start the business. Okay, so or to compare the investment also. Okay, then next point, or the next criteria for the evaluation of investment, that is nothing but average return on investment. Okay, so it is called as a return on investment also, and in a short form it is noted as ROI. Okay, capital ROI. So it is defined as a ratio of net average income from the project to the investment made in the project. Okay, so net average income, or the net, first of all, net income is defined as the difference between the net cash flow and cash inflow and cash outflow. This is called as the accounting rate of return. Okay, so income for a year, that is nothing but how much amount of money you have spended to get that particular income, that is nothing but cash outflow. And how much money you received after selling that particular products, or products out of that particular business, or through that particular business, how much money you have earned, that is nothing but cash inflow. Okay, so net income is nothing but what, cash inflow minus cash outflow, so that will be the net income. So it is also called as the accounting rate of return. Okay, so we have seen the formulas for this particular average rate of return, and it can be expressed as a profit after tax. Okay, so once you get the profit, over that particular profit the tax will be applied. Okay, so in India there are mainly two different taxes are there, CGST and HGST. Both are having 9% valuation of a profit. So this taxes, total 18% tax will be applied over the profit, and this particular profit after taxation we have to consider for the average rate of return. Okay, so profit after tax, that is nothing but PAT divided by book value of investment. Book value of investment, that is the average rate of return. So if you want to write down that particular average rate of return in the form of a percentage, then just we have to multiply with 100. Just we have to multiply with 100 to the average rate of return. So profit of after tax divided by book value of investment multiplied by 100. That will be the average rate of return in form of a percentage. Okay. So we reach up to this point in the last lecture. Now, what are the advantages of this particular uh, ROI, or we can say that average rate of return? So first one is nothing but there, once again the calculations are simple one. Okay. And we can say that this particular value, that is nothing but cash inflow and cash outflow, it is readily available with the account department. So this is one kind of accounting information, and we can get this particular information from the finance department also. So it consider benefits over the entire period of project life. In payback period, we have seen that payback period is concerned uh, for that period only in which the investment are recovered by the company. Okay. So but this particular rate of return criteria can consider over the entire project life. Okay. If you want to say that payback period is 5 year, okay, and business run for 10 years, so payback period will consider only 5 years, but this particular uh, uh, return on investment will consider the 10 year tenure for that particular calculations. Okay. So these are the advantages for ROI, or we can say that average return on investment. So then what are the disadvantages for this particular methodology? It is based on accounting profit, not on a net cash flow. So we have to consider the difference between the account, what is meant by accounting profit and net cash flow. So accounting profit is only concerned about the in cash flow inside the company and cash flow outside the company. So that is nothing but what? It is one kind of a statement. Okay. How much money received and how much money uh, goes out of that particular company, or how much money expended by this particular company, okay, during that particular tenure. So that is nothing but just the accounting statement. Okay. Whereas net cash flow is nothing but what? It consider the we can say that amortization cost also, or uh, it is also called as one. If you want to understand this particular net cash flow, if you purchase one bike and if you want to sell that particular bike, okay, so the cost of that particular bike will not be the same. Okay. It will change, and it will somehow you will get the some less amount than the purchase amount. Okay. So that is nothing but what? This consideration will taken into account in a net cash flow. Okay. Whatever the machinery uh, or the facilities purchased by the company, the value of that particular facilities also changes according to the time period. Okay. So this will take into account in a net cash flow, whereas in account profit, it will be just the statement of account only. Okay. So this average return on investment only consider the account profit, not consider the net cash flow. Then does not take into account the time value of money. Okay. Here also the time value of money will not be considered for the calculation purpose. Then average rate of return measures is initially little consistent. Over the time period, the calculation is constant one. It will not change. Then this method also does not take into account. Okay. So the same statement is repeated over here. Does not take into account the time value of money. Okay. Then we have to consider one example to understand what is meant by average return on investment or return on investment. Okay. Please note down this particular formula problem and try to solve the problem. So assume an investor bought 1,000 shares of the hypothetical company Worldwide Wicket Cooperation at $10 per share. Okay. So one hypothetical company is there, and one investor uh, bought 1,000 share of that particular hypothetical company with a valuation of $10 per share. Okay. Then 1 year later, the investor sold the shares for $12.50. Okay. then after 1 year, the investor want to sell that particular share, and the investor sell that shares for $12.50. The investor earn dividends of $500 over the 1 year holding period. Okay, so during that holding period for 1 year, so whatever the profit earned by the company, it will be divided in in their stakeholders or shareholders. Okay, so that is called as a dividends. Okay, so profit sharing. So during that particular period, the investor get or earn the $500 dividends. Okay, over the 1 year holding period. Okay, the investor also spent a total of $125 on a trading commission. Okay, so to buy a share or to sold that shares, we need to pay something. Okay, so or the investor has paid $125 for trading purpose. Okay, so trading commission in order to buy and sell the shares. Okay, now we have to find out the ROI, return on investment. Okay, we have to find out the ROI, that is nothing but return on investment. So write down the problem. Everyone, have you noted? Please note down the problem. It will require to understand the concept. Assume an investor bought 1,000 shares of the hypothetical company Worldwide Wicked Corporation at $10 per share. 1 year after, the investor sold the shares for $12.50. The investor earned dividends of $500 over the 1 year holding period. The investor also spent a total of $125 on trading commissions in order to buy and sell the shares. Okay, find out the return on investment. Find out the return on investment. So write down. Have you written, everyone? Shall we move ahead for the solution of this particular problem? Okay. Everyone, shall we move ahead? Now, what is the initial investment or book value of investment? So the initial investment is $10 multiplied by 1,000 share. One share value is $10. Okay, and the total number of shares purchased, that is nothing but 1,000 shares are purchased. So initial investment or book value of investment is nothing but 10 multiplied by 1,000. Okay, so that is one given data. Then second one, the profit earn. Okay, so profit earn is nothing but, or the sold value. So sold value is nothing but $12.50 is the selling value of per share multiplied by total number of shares, that is nothing but 1,000. Okay, so 12.50 multiplied by 1,000. Okay, so that is the selling value of the investment. Okay, then what is the profit? Okay, so for the profit purpose, we have to consider the dividends also. Okay, so dividends $500 initially, the selling value plus dividend minus the initial investment, that will provide you profit. Okay, and what will be the profit after tax. So profit minus trading commission will provide you the profit after tax. Okay, selling the profit minus commission for the trading will you'll get the profit after tax. Okay, so book value is we can write book value of BVT. Book value is equal to 10 multiplied by 1000 share. Okay, or the initial investment. So that is nothing but near about that is nothing but $10,000. Okay, so initial investment or book value of investment is $10,000. Then next is nothing but profit after tax. Okay, so so book value is 1000. Okay, book value is 1000 minus the selling cost is 12.5 multiplied by 1000 shares. Okay, plus dividend is nothing but one kind of a profit earned for the holding period. Okay, over the holding period. So $500 should be added minus 125 minus 125. So that is nothing but 125 is the taxation over that particular transaction. Okay, so you will get near a value of $2,875. So that will be the profit after tax. That will be the profit after tax. Then we have to find out the average rate of return. Okay, average rate of return. Okay, then uh, the profit after tax divided by book value of investment multiplied by 100. Okay, so ROI is equal to 2,875 divided by 10,000 multiplied by 100. Okay, so you'll get the average uh, rate of return or return on investment is equal to 28.75%. That is nothing but what it mentions how much profit you will get after investing per dollar. Okay, after investing per dollar. So for $1 you are getting the profit of 28.75%. Okay, over the $1 you will get the profit of 28.75%. Okay, so that is nothing but average rate of return. Getting everyone? Okay, Vaibhav Dandge is saying 2875. Okay, so further that will be the profit after tax. Next we have to find out the average rate of return. Okay, everyone getting 28.75%, or or another value you are getting? Please mention in the chat box whether you are getting the same value or another value. Okay, have you written, have you noted this particular problem? Shall we move ahead? Okay, so so next evaluation criteria is net present value. Okay, net present value. Please note down the name of criteria. Net present value. It is also called as a NPV, net present value, or it is also called as a NPV. Okay, so this particular net present value to calculate or the criteria which will find out the value of earning for the future business, or we can say that if you want to invest in any kind of a business, so what will be the payment or payback for that particular investment for the future period. Okay, so this particular valuation we will get through this particular net present value. And most important thing is nothing but this particular methodology take into account the time value of money also. Okay, so which is not covered in payback period, which is not covered in uh, return on investment or average return on investment, but this particular net present value account for the time value of money also. Okay, and this particular NPV is used in capital budgeting and investment planning to analyze the profitability of projects, projected investment or project. Okay, so in every case, in any kind of a business, this particular NPV is used to evaluate the business scenario for the future. Okay, what will be the business scenario for the future? So NPV analysis is a form of important valuation and is used to extensively across finance and accounting for determining the value of a business. Okay, this method of a project evaluation takes into account the time value of money. Okay, how come it will be take into account the time value of money? So for that purpose, one important parameter is used in the net present value. That is nothing but discounting. Okay, that is nothing but discounting. So cash flow in net present value analysis are discounted. Okay, so what is the purpose of discounting, or why the cost is discounted? So there are two important purposes for a discounting. First one is nothing but to adjust for the risk of an investment opportunity. Let us consider there are two businesses. One is well settled business and one is newly launched business in a market. Okay, so and there is a investment opportunity, then one have to think about the risk also. Okay, one have to think about the risk also. So well settled business having low risk. Okay, whereas new established business in the market having more risk. Okay, so this risk will be accommodated in this particular discounting. Okay, so the more riskier having more discount. Okay, and less riskier having the less discount. Okay, so initially you consider this point only to adjust for the risk of investment opportunity. Okay, necessary, not all businesses, projects or investment opportunity having the same level of risk. Okay, so it will change business to business, it will change organization to organization also. Okay, to account for the risk, the discount rate is higher for a riskier investment and lower for the safe one. Okay, then second one is nothing but we have to account for the value of money. Okay, that is nothing but time value of money. Okay, so time value of money, that is nothing but what? Mahagai avshakte, that is nothing but inflation. Okay, so we have to account for the inflation also. Then interest rates, the money is more valuable the sooner it's received. Okay, so if you want to receive the money now and after 5 years, okay, same amount of money you want to receive at the present situation and after 5 years, so which will be better? Okay, so obviously to receive the money as soon as possible, it will be better than it receive the later on, because the value of money changes day by day. Okay, so you have taken the example, noted one example that if you want to take the loan from the bank and you want to pay back that particular loan, then the more amount you have to pay instead of the same amount. Okay, or you can say if you invested in a share market, then sometime the value of that shares goes on increasing over the time period. Okay, and the value of that particular money will not be same. Okay, also inflation rate, that is nothing but mahagai. Nowadays we can see the news related to the inflation rate. Okay, so महागाई दिवसेंदिवस वाढत चाललेला आहे. There is an inflation rate of 4%, there is an inflation rate of 6%. Now to account this particular bank loan interest, or to account this particular inflation rates, one have to consider the time value of money. Okay, one have to consider the time value of money. To account these two factor, okay, that is nothing but the risk of investment and the time value of money. To account these two particular factors in NPV, net present value, the discounted discount cost is used. Okay, discounted rate is used. Okay, so how it is useful in this particular method, we'll see here. This is the particular formula for the calculation of NPV. So NPV will be equal to FV naught divided by 1 plus R naught bracket raised to T naught, okay, plus FV1 divided by 1 plus R1 bracket raised to T1 plus FV2 divided by 1 plus R2 raised to T2, where this FV naught, R naught and T naught indicate the expected future values, applicable rates and time period. Okay, FV naught is nothing but expected future value, then R naught is nothing but applicable rate, or we can say that discounted rate also. Okay, then this T naught is nothing but time period. So this T naught is T naught, if you consider T naught as 0 at a present situation, we are calculating this. So investment at a present situation, we are considering. So for that purpose, the investment for first factor FV naught will be the initial investment. Okay, T naught is the starting period. So the starting period here we have to consider as a 0. R naught is the discounted rate or the applicable rate. Okay, applicable rate we have to write over here. Then for the next, what will be the earning over that after 1 year? Then here that particular earning, net earning will be there. Then T1 will become the 1. Okay, plus in bracket it will become 1 plus discounted rate. Okay, in this manner, how much year the project will be there, for that particular years we have to calculate all these things. Okay, we have to write down the formula, or we have to write down the formula for that all the periods. Okay, so T0 T1 T2 are the periods. Okay, R0 R1 R2 are the discounted rates. Okay, and whereas FV0 FV1 FV2 are the future values. Okay, future values. Okay, so please note down this particular formula. Initially you write down something about the net present value. Okay, getting everyone what is meant by net present value? Okay, when we take one problem, we will better understood from that particular problem. Okay, so please note down some points related to the net present value. Is there any question, any doubt you can ask? No problem. Over. Shall we move ahead to the next slide? Please mention in the chat box if you required more time. Shall we move ahead? Now important thing that how to calculate, or how we will come to know that what will be the future payment for that particular project. So it is one kind of a it will come after the experience, or if company want to invest in a similar kind of a project, then the previous in the previous project, uh, uh, how the company get the earning from that particular business. So in a similar fashion, we will apply the future stream of payment for the new business also, or for the new investment also. Okay. Okay, we'll move to the next slide. Then cash flow. The cash flow in net present value analysis is discounted. Okay. So discount is provided to accommodate the risk and to accommodate the inflation rate, or depreciation cost, or interest rate. So note down the points related to the discount. Why this particular net present value analysis is discounted? Because to adjust for the risk of an investment opportunity, and to account for the time value of money. To account for the time value of money. Getting everyone? Is there any question? Any doubt? Okay, shall we move ahead to the next slide? Write down the formula for the NPV. Okay, write down the formula for the NPV. NPV is equal to FV naught plus divided by 1 plus R naught raised to T naught plus FV1 divided by 1 plus R1 raised to T1 plus FV2 divided by 1 plus R2 raised to T2 up to FV suffix n divided by 1 plus R suffix n raised to T suffix n. Okay, so where this FV naught is nothing but expected future value, then R naught is discounted rate or applicable rate, and or R is equal to discounted rate or applicable rate. Then T is nothing but time period. Okay, T is nothing but time period. So note down the formula. Over. Shall we move ahead to the next slide? Please mention in the chat box, have written the formula or not, and related notification. Shall we move ahead? Okay. So important rule associated with the NPV, that is nothing but decision rule. So that will signify why the NPV is required to carry out at the start of the business. Okay. So if this particular NPV value is a positive one, then that project should be accepted. Okay, that is nothing but what? The project will be in a profit in the future. Okay, the project will be in a profit if this particular NPV value is positive one, and the NPV value is negative one. That will mention that the project will be in a loss in the future, or the business will be in a loss in the future. Okay, so we will come to know after calculating NPV value whether the project is should be accepted or the project should be rejected. And the present value 0 represent the indifference. Okay, there will not be profit or loss, uh, or there will not be any gain by running that particular business or by doing that particular investment. Okay, so present value 0 represent the indifference. Okay, and most important, if this particular project value NPV value is positive one, then uh, the project should be accepted or investment should be done in that particular project. If this NPV value is negative, then the project should be rejected, or one have to avoid the investment in that particular project, or one have to avoid that particular investment. Okay, so please write down decision rule associated with NPV. Whether my voice is getting to everyone? Please mention your comments. Okay, okay, okay. So uh, whether you are getting or not this NPV. Okay, somewhat these particular methodologies are related to the finance. Okay, so somewhat difficult, but you will understood thoroughly after solving the example. Okay, after solving the example. Shall we move ahead to the next slide? Please note down the points, 2 points related to the decision associated with NPV. Okay, so next one is nothing but advantages. So we have considered this advantages also while discussion. That is nothing but it takes into account the time value of money. Then it considers the cash flow throughout the life of the project. Okay, so in payback period, we are payback periods are not considering the cash flow throughout the life of a project. It will consider only for the the time period where in which the return from that particular project uh, will equal to the investment. Up to that particular time period only the payback period consider, but in ROI and in NPV the cash flow is considered throughout the life of the project. Then NPV contributes to the wealth maximization of a stakeholder. This is the most important point. Actually, it is considered the time value of money and inflation rate, then rate of interest. All these things are considered in a discounting of a cost. So it will help to increase the wealth of stakeholders also. It will help to increase the wealth of stakeholders also. Okay, so these are the advantages related to the NPV. These are the advantages related to the NPV. Please note down the advantages. Over. Shall we move ahead to the next point? Okay, so we'll take the problem on this particular NPV method. Okay, so important problem. Note down, please note down. The initial investment and net cash flow for two project proposals A and B are given in table below. Okay, the initial investment and net cash flow for two project proposals A and B are given in table below. Select the project based on NPV, assuming discount factor of 15%. Assuming discount factor of 15%. Okay. So proposal A and proposal B is provided for the starting period. Okay. At the present situation, zero is nothing but what? Present situation. Okay. And during that present situation, the investment is done on that particular project. Okay, investment is done on that particular project. So net cash flow, okay, net cash flow will be -1. Net cash flow will be -1. Okay, so that it is mentioned over here, that will be the investment minus 10,000 is the investment. In a similar manner, for the B type of project proposal, the investment is minus 10,000 only. Okay, for the first year. Okay, after completion of 1 year, the profit we will get of 3,000 for the proposal A, and profit or the net cash flow will be 3,000 for the proposal A, and the net cash flow for the proposal B is 6,000. Okay, then at the end of second year, the net cash flow is once again 3,000 for the proposal A. The net cash flow for the proposal B is 6,000 rupees. In a similar fashion, for the third year, the net cash flow for the proposal A is 7,000. Okay, here I have written 70,000. Please note down 7,000. Okay, 7,000. Okay, 7,000 for the third year for proposal A, and net cash flow for the proposal B for the third year is 3,000. For the fourth year, net cash flow is 6,000 for proposal A and 3,000 for proposal B. Now, here we have to consider that we are at a starting phase. That is nothing but what? Investment phase. Okay, and these are the assumed cash flow for the next 4 years. Okay, these are the assumed cash flow for the next 4 years. So project will be last long for the 4 year only. Okay, so project life is 4 year, and we are at the initial stage. So in that case, we have to select which proposal is best one. Okay, which proposal is best one to invest in that particular project. To invest in that particular project. Have you noted the problem? Okay, and here we have to consider that the discount factor or a discount rate of 15%. Here we have to consider the discount factor or discount rate is equal to 15%. Now, on this particular data, we have to calculate the NPV. Okay, net present value we have to calculate, and we have to select the proposal. We have to select the proposal. Okay, that is our problem. That is our problem. Getting everyone? So please note down the problem statement. Okay. Shall we move to the solution? So the given data, okay, first of all, the given is provided that discount rate is provided or discount factor is provided, and that is nothing but r. Small r is equal to discount factor or discount rate, and it is equal to 15%. Now we have to find out the NPV values for the proposal A and proposal B. Okay, so for that purpose, initially we have to write the formula for NPV. So NPV is equal to FV naught divided by 1 plus R naught raised to T naught plus FV1 divided by 1 plus R1 raised to T1 plus FV2 divided by 1 plus R2 raised to T2 up to FVN divided by 1 plus R suffix N raised to T suffix N. Okay, so that is the general formula for the NPV. Now we have to calculate for the 4 years only. Okay, so we can write the formula up to FV4. We can write the formula up to FV4 divided by 1 plus R4 bracket raised to T4. Okay, bracket raised to T4. Up to that only we can write this particular formula, and next we have to calculate. So FV naught is nothing but what? The cash flow value for the 0 year. Okay, for the 0 year or the starting year. Okay, cash flow value for the 0 year or the starting year. So in the starting year, we have made the investment. We have made the investment or that particular, so in that particular proposal, the investment is made for that particular 0 year. Okay, that is minus 10,000. Okay, so the FV naught will be equal to minus 10,000. Okay, FV naught will be equal to minus 10,000 divided by 1 plus the discount rate is 15%. So 15%, that is nothing but what? 0.15. Okay. Now the period is 0. Okay. Period is 0 or a starting period. Okay. So it will be raised to 0. Okay. It will be raised to 0. Obviously. So raised to 0 is nothing but the divide factor will becomes 1 only. So we can write as it is minus 10,000. Okay, we can write as it is minus 10,000. So the next cash flow for the first year is 3,000 for the proposal A. Okay, cash flow is 3,000 for the proposal A. So period is 1. Okay, so FV1 divided by 1 plus R1 raised to T1 will become FV1 is 3,000 divided by discount factor is constant. So R0, R1, R2, all these values becomes constant. So 1 plus 0.15 and the first period is there. So for that purpose, raised to 1. Raised to 1. Okay. Plus the FV2 value is for the proposal A is 3,000 only. So we have to write the 3,000 as a FV2 divided by 1 plus 0.15 raised to 2. For the second period, it is there is a this value is for the second period, so raised to 2. Okay, we are considering the second period. Then for the third year, plus 7,000 divided by 1 plus 0.15 raised to 3, because the time period is third, or we can say that year is third year is there, so for that purpose here the rest factor becomes 3. Okay, so 7,000 divided by 1 plus 0.15 raised to 3, plus 6,000 divided by 1 plus 0.15 raised to 4 raised to 4. Okay, so here for the fourth year the cash flow is 6,000 rupees. So for that purpose we have considered f v4 equal to 6,000 divided by 1 plus r4 becomes 0.15 only, because discount factor is constant 1. So 1 plus 0.15 raised to 4 raised to 4. Okay, so calculate now all these values and calculate NPV. So NPV equal to, so first calculation will becomes minus 10,000 as it is. Okay, plus the second calculation will becomes 2,608.695, plus third calculation will becomes 2,268.431. Then the next calculation will become 4,605.263 plus 3,430.53. Okay, so after adding all these calculation, we'll get the actual value or the net present value equal to 2,912.92. Okay, 2,912.92. Okay, everybody getting the same value or you are getting different value? Please mention in the chat box. Whether you are getting the same value? Do calculation everyone and tell the value 2910.24. Okay, 2912.50. Okay, I think some point difference will be there. Okay, that will be accountable in NPV, no problem. Same Pradyuman getting the same value. Okay, okay, so the difference in point only. So if you are getting the difference in points, then the value will be changed over here. So but that will be accountable, no problem. So NPV 2,912.92, because we are comparing only two proposals, so this can be acceptable. Then we have to calculate the NPV for the proposal B. Okay, so for the proposal B, once again we have to write the formula for the NPV. Okay, net present value formula, that is FV naught divided by 1 plus R naught raised to T naught plus FV1 divided by 1 plus R1 raised to T1 plus FV2 divided by 1 plus R2 raised to T2 up to FV4 divided by 1 plus R4 raised to T4 raised to T4. Okay, so in this manner also we have to consider the values of B proposal. Now here we have to consider the values of B proposal. So minus 10,000 here for the 0 or the starting period, because here we are doing the investment, so net cash flow will be negative. Net cash flow will be negative for the starting period. So 10,000 is the investment, so for that purpose it is negative, it is having the negative sign. Okay, so here once again we have to mention all these values of FV0, FV1, FV2 up to FV4. Okay, and once again we have to divide these particular values by adding the discount factor with 1, and by providing the rest factor with respect to time period. Okay, so minus 10,000 divided by 1 plus 0.15 raised to 0, plus for the second year for the B proposal, the net cash flow is 3,000. So 3,000 divided by, so it is, I'm maybe wrong. Okay, so solution B. Okay, solution for B proposal. So net cash flow for the first year is 6,000 rupees for first first year. Okay, so 6,000 divided by 1 plus 0.15 raised to 1, plus second cash flow for the second year is 6,000 once again divided by 1 plus 0.15 raised to 2, because the second year or time period is second one. So for that purpose we have to provide the 2 as a rest factor, plus 3,000 divided by 1 plus 0.15 raised to 3, plus 3,000 divided by 1 plus 0.15 raised to 4. Okay, do the calculation, so you will get the values, and at the end you will get the NPV value. At the end you will get the NPV value. So NPV will be equal to 3,443.19. 3,443.19. Please check whether you are getting the same value or there is some difference. So after comparing these two values, okay, NPV for the proposal A and NPV for the proposal B. So net worth, or we can say that net present value for the for the proposal B is more than the proposal A. Okay, so we can say that the NPV of proposal B is higher than A. Hence, select the proposal A. Hence, select the proposal B. I have made mistake over here. Hence, select the proposal B. Okay. NPV proposal B ची NPV व्हॅल्यू प्रपोजल ए पेक्षा जास्त आहे, त्यामुळे आपण प्रपोजल बी सिलेक्ट केलं पाहिजे. ओके, सो इन दिस फॅशन दिस पर्टिक्युलर NPV is useful to select the business and to reject the business. Okay, to select the business and reject the business. Okay, because it will take account the time value of money. It will take account for the time value of money. Now here you have earned the 3,000 rupees for the first year. Consider that you have earned the 3,000 rupees for the first year, but its time value of that particular money is only 2,608. Okay, it is only 2,608.695. You have earned 3,000 rupees for the second year, but its time value for that 3,000 rupees for the second year, it will equal to 2,268.431. You have earned 7,000 rupees for the third year, but in actual the time value of that particular 3,000 for the 7,000 is 4,605.263. You have earned the 6,000 rupees for the fourth year, but its time value is 3,430.53. Okay, getting everyone how to consider the time value of money. Okay, how to consider the time value of money for the 0th year. For the 0th year means what? Now the present situation, whatever the money is there, the value of money is this much only or that much only. Okay, so time value of money for the 0th year will be same. Okay, the time value of money for the 0th year or the investment year will be same only. Okay, it will not change. But whatever the earning for the next year, for that particular next year earnings, the time value should be considered. Okay, the time value should be considered. So by considering these values and by comparing the actual earning, so these values are lesser than the earning. Okay, so that is nothing but these are the time values. These are the time values. Getting how to calculate the time values of money by using the discount factor, and how to accommodate this all these things in a NPV, and how to select the project proposal, or how to made the investment in any project. Okay, getting everyone? Any question, any doubt? If you have any question, you can ask. Now I will take the attendance. Roll number 1,
Yes, sir.
2. Roll number 2 absent. 3 absent. 4,
Present, sir.
5, 6,
Present, sir.
7, 7, 7 absent. 8 absent. 9,
8.
8 absent.
8. Yes, sir.
Akash Bishe, what is your roll number? Your roll number 10 now? Akash?
Yes, sir.
Okay. 11,
Yes, sir.
12, 13, 14, 15, 16,
Yes, sir.
17,
Yes, sir.
18, 19, 20, 21,
Yes, sir.
20,
Yes, sir.
22, 20,
Yes, sir.
Pratik, 22. Okay. 23. Pratik, you can mute yourself. I have marked your attendance. 23 absent. 24. 25.
Present, sir.
Ruturaj, what is your roll number?
24.
Okay. 25. 26. 27. 28.
Yes, sir.
Vivek, roll number?
Yes,
27
sir.
or 28?
26.
26. Okay.
26,
27.
sir.
Huh?
Yes, sir.
26, no? 27.
Sir. 26.
Okay. 27 absent. 28. 29. 30. 31.
Yes, sir.
30 Abhishek. Okay. 31 absent. 32. 33.
Yes, sir.
33 Mahesh. Okay. 34. 35. 36.
Present.
Shahid.
Sir. Present, sir.
34, no?
35.
Shahid 35. Okay. 36. 36. 37.
37, yes, sir.
38,
Yes, sir.
39, 40, 41, 42, 43,
Yes, sir.
40, 41. Who is 41? 41 absent. 42,
Yes, sir.
42 present. Who is 42?
Purvesh, sir.
Okay. 43, 44,
Yes, sir.
Ganesh 44. 45, 46, 47,
47, sir. Present.
47 present. Okay. 48, 49, 50, 51, 52, 53, 54,
Yes, sir. 54.
54. Okay. 55, 56,
Yes, sir.
56 present. Okay. 57.
Present. 57.
Okay. 58, 59.
Yes, sir.
Okay. 59 present. 52, 50, 60, 60, 60 present.
Sir.
Okay.
Yes, sir.
61,
Present, sir.
61, 62, 63.
Present, sir. 63.
Okay. 64.
Present, sir. 64.
Okay. 65,
Yes, sir.
66.
Yes, sir. Hello, sir.
1.
Hello, sir.
Mark 66. No problem.
Okay, sir.
67, 68, 69,
Present,
70,
sir.
59. Avinash.
69, sir.
Okay. 70.
Yes, sir, 70.
Okay. 71,
Present.
72, 73, 74, 75,
Yes, sir.
75. Okay. 76, 77, 78.
Yes, sir. Present, sir.
76 na Jivan.
77.
77. Okay. 78.
77.
Okay. No problem.
Okay.
78, 79, 80, 81, 82. Okay. Anybody else?
Sir, A8 लागली ना?
Roll number 8. Okay. Mark.
Yes, sir.
No problem.
7, sir.
Okay. Rohit 7. Mark. No problem. Next.
836. 836.
Wasim 36. Mark. Next. Or
Sir, roll number 6.
76 mark. No problem. Roll number 2, 3, and 5 absent. Okay. Roll number 80 marked. No problem. 75 already marked. No problem. 77 marked. No problem. 63 marked. No problem. 71 marked. No problem. Roll number 6 marked. No problem. Roll number 16 marked. No problem. 61 Mahesh Shinde marked. No problem. 21 mark, no problem. 36, no problem. 36 mark. 57, 57 mark, no problem. Roll number 8 mark, no problem. 32, 32. Okay. Roll number 7 mark, no problem. Okay.